Welcome to a session titled An Overview of the Financial Plan section of a business plan. You may remember that we defined a business plan as a guide which outlines the objectives of a business. It then gives details about what the owners of the business must do to achieve those objectives. A business plan consists of 4 sections or sub-plans. These are called marketing and sales plans, production plan, people plan, and finally financial plan. So far, we have looked closely at the first 3 sections. In this session, we will take a closer look at the financial plan section or sub-plan of a business plan. Let's define the context for the financial plan section and also do a quick overview of it before going into the details. You may recall that the marketing and sales plan section mainly dealt with forecasted revenues of a business. Production plan and people plan mainly dealt with forecasted costs of a business. Financial plan brings these items together to create forecasted P&L and other forecasted financial statements. It looks at the working capital and fixed capital needed to start and run the business as well as the sources of capital. Additionally, it looks at the parameters to which business's financial performance is very sensitive to and then verifies that the business can withstand unfavorable changes in these parameters. Now that we have established the context and have a brief overview of the financial plan section, let's look at its details. The financial plan section focuses on forecasting the financial health and performance of a business. There are a number of considerations which go into ensuring soundness of both these aspects. This section prompts the entrepreneur to think about these considerations by asking her a series of questions. We will look at a set of 10 important questions which are typically included in this section. The first question is, what is the forecasted profit and loss or P&L of the business for each month of the year, for the entire year and for 2 more following years? Creating forecasted P&L requires estimating revenues and costs. These forecasts come mainly from sales plan, production plan and people plan sections of the business plan. Often, new businesses tend to make losses for a few months since revenues take some time to build, but costs begin at once. Hence, forecasting P&L helps an entrepreneur anticipate what kind of losses the business is likely to make in the coming few months. This in turn helps her to plan for the required capital to absorb those early losses. If the business is forecasted to make losses even after a year or 2 years, then the entrepreneur needs to go back to the previous sections. She should then make changes to those sections and see if the business is expected to become profitable. The second question is, what is our forecasted cash flow for each month and for the whole year? Business can have profits but no cash at the end of a month or year. This is usually due to unfavorable credit policies. But a business can't run without cash. Hence, for every entrepreneur, it is crucial to create a forecasted cash flow based on forecasted revenues, forecasted costs and credit policies to understand if there is likely to be a shortfall in cash for a given month. If the shortfall is significant and is expected to continue for many months, then again some adjustments are needed in the previous sections. The next 2 questions are about capital needed in the business. The third question discusses fixed capital needed to start the business. The major input for the answer comes from the equipment and infrastructure needed for the business, which is described in the production plan. If the business plans to buy the equipment, then fixed capital amount goes up. If instead it is rented, then the costs and cash outflow go up every month and they put pressure on the monthly working capital. This is what the fourth question focuses on. Working capital is the amount of money which can never be taken out of the business as it is always needed to run a business. If the forecasted cash flows from the second question has indicated a shortfall, then it means that there is a need for additional working capital during that month. For seasonal businesses, there could be 1 or 2 months where the working capital required suddenly goes up so as to buy a lot of raw material. The fifth question is, from which source, equity or loans or both, will the business get the required capital? The amount in the question covers fixed and working capital. The entrepreneur may put some or all of the required capital in the business. This is called equity contributions. But often, owners do not have enough money to meet the entire capital required. So, they may consider taking loans from a bank or friends and family. Once the entrepreneur is clear about the sources of capital, questions 6 and 7 help her with the specifics of the two sources. The sixth question focuses on loans and is designed to get the entrepreneur to analyze 3 important aspects of a loan. These are the loan amount called principal, duration of the loan in years, and the annual rate of interest to be paid. Question 7 is about equity contributions. It talks about what the equity investor will get from the business in return for giving the capital. For a one-person business, this is not an important question, but for a group business, this is a crucial question. In such cases, the question is meant to help the group of entrepreneurs to decide who will get how much share of profits and what roles the group members will play in making important decisions in the business. Question 8 is, what is the forecasted balance sheet of the business for the next 3 years? Balance sheet shows the long-term health of a business. Major inputs for forecasted balance sheet are forecasted P&L, forecasted cash flows, and sources of capital. For any business, the growth in balance sheet due to higher retained earnings is healthy. Banks look at a healthy balance sheet favorably when they approve loans for a business. This question is very helpful if the business plans to take a bank loan. By answering the 9th question, an entrepreneur is able to identify those parameters to which the business's financial performance is sensitive. Some parameters such as production yields are within business's control to some extent, but parameters such as prices of raw materials are not under the business's control. The 10th and the last question is related to the 9th. It is, what will be the changed forecasted P&L based on changes in the top 2 or 3 parameters? Once the sensitive parameters are identified, the entrepreneur then understands the impact on the P&L. A rule of thumb is that if it is a cost-related parameter, the forecasted P&L should be recalculated by increasing the value of the parameter by 10%. If the parameter is price or volume, both of which are related to revenues, the forecasted P&L should be recalculated by decreasing the values by 10%. In spite of these unfavorable changes, if the business is still likely to make a profit, then it is a good business idea and a sturdy business plan. You may remember from the session on the overview of business plan that the 4 sections are connected with each other. Hence, the process of preparing a business plan is an iterative process. Often, analysis done during the preparation of the financial plan section leads to changes in the other 3 sections. Thus, Financial plan is crucial for the entrepreneur to decide if she should go ahead with the business or not. To summarize, financial plan brings forecasted revenues from the sales plan and costs from the production and people plan to create forecasted P&L and other financial statements. It also looks at working and fixed capital needed to start and run the business as well as sources of the capital. The financial plan finally looks at sensitive parameters and the impact of changes in their values on the P&L of the business. Analysis of the questions in the financial plan often leads to changes in the other three sections of a business plan. That briefly is about the financial plan section of a business plan.